All right, here we go with Chapter 7, Part 1. So Chapter 7 is all about investments and how they're taxed. And it helps, I think, to do this after Chapter 11 because it helps if we understand what things like an unrecaptured 1250 gain are before we calculate tax on those. So investment income can give us gross income, right? Pretty much any investment income that we have will be here unless it's something like municipal bond interest that's excluded in the tax code. Most investment deductions will be here above the line, all right, because things like rental expenses get above the line treatment. The only thing we'll deduct down here is investment interest expense is allowed as an itemized deduction. So here's an interesting story from the news a couple years ago with a lot of tax angles. One thing to learn here is that the IRS has a whistleblower program, right? So if you basically tell on the company or organization that you work for that you think they should be paying more taxes, and because of your tip, the IRS recovers money, you can get a percentage of that money, right? You can potentially make a lot. So this guy worked for Vanguard, right? Vanguard's basically known for, right, they have mutual funds and ETFs. Vanguard's big thing is, right, they have the lowest fees in the industry. The founder, John Bogle, is one of those guys who's just kind of frugal and he loves saving money. And so the whistleblower says that one of the things they use to lower their expenses violates tax rules related to transfer pricing, and that's why he's claiming they should pay more money. Seems unlikely that the IRS and the Justice Department are going to want to go after mutual funds that are mostly owned by pension funds and middle class investors and things like that. So the other thing to learn here is, right, I pulled this part out of the story, is that Vanguard's average expense ratio is 0.16% compared to the industry average of 1.16%, which seems like small difference. But over a lifetime, right, if you're talking about retirement investing, that 1% difference could shrink your retirement nest egg by 40%, right? Is that tax differences compounded over time. So the point here is taxes can make a big difference on investment returns. What we care about, right, is how much money we actually get to keep. We talked about this with tax planning. So when we're investing, we're trying to maximize our after-tax return. That's going to be determined by timing, right? So especially when we're talking about retirement investing, being able to defer things over many years with the time value of money can really make a big difference. The character also is the other variable here, right? Because different characters of income have different tax rates. All right, so we're going to divide our investment income into two different types here. Portfolio income is going to be, right, most of the things you would think about owning as an investment: interest, dividends, capital gains and losses, royalties, annuities. Passive activity income means you've invested in a pass-through business entity, like a partnership or an S corp or an LLC. And so, or you directly own real estate, but you're not actively involved, right? So all ways where you, right, for example, you're a limited partner in a business. So you have a share of the earnings, but you don't actually work, right? You don't actively work towards it. We'll call that passive activity income. And it's going to have its own limits and rules. First, we'll talk about portfolio income. It's a little cartoon. It's your portfolio, right? You'll hear people talk about my portfolio of investments, 1999 to 2003. This will be apt for 2020. Although even pepperoni might be a little hard to come by these days. Wish I had invested in toilet paper. So interest, right? A common type of portfolio incomes, right? So this could be from a savings account at your bank, a certificate of deposit. You own bonds, corporate bonds that pay interest. You own treasury bonds, right? So this all interest is always taxed at ordinary rates, unless it's municipal bonds from state or local governments, which is excluded from federal income tax. Also, states with an income tax won't tax interest on federal, right, treasury bonds. One weird rule we already saw in Chapter 9 is the original issue discount. So our example from that was, right, so even if somebody's on the cash method, if they buy a bond like this at a discount, right, so Laura buys a bond with a face value of 100,000, but she only pays 85,733. Right? So it doesn't actually pay any interest until the very end. She just gets 100,000, right? The interest is built in through the discount. And so even though she doesn't get any money in year one, she has to be taxed as if she did. So we'll take the amount she paid for the bond times the stated interest rate. That's her income in year one. Then we're going to add that imputed interest from year one to the carrying value, right? We're amortizing the discount, and we'll multiply that new number times the stated interest rate, and we get her income for year two. Dividends are usually taxable when received. We talked about this rule, right? It's if you're the owner of record on the record date, then you're the one who gets taxed on the dividends. Qualified dividends are taxed at 0, 15, or 20%, just like long-term capital gains, and depending on your other income, your ordinary income first, where you're at. All right, so obviously 15% is going to be the most common. So what do we mean by qualified dividend? Qualified means it's a domestic corporation, certain foreign corporations, right? So mainly what's being excluded here is foreign corporations. Right? We're not trying to encourage investment in other countries through our own tax code. And you have to hold the stock for a certain amount of time. Specifically, if we take the ex-dividend date and we count the 60 days before that day and the 60 days after that, gives us 121 days. During that time, you have to have owned the stock for more than 60 days. Right? Why is that? Right? Suppose a stock is trading at $50 per share. They declare a dividend of $5. Right? If I know they've declared a dividend, and so I swoop in and I buy the stock right before, right, the record date. After this company pays a dividend, right now they have less assets. There's less cash in the company, right? We would expect the share price to go down to about $45 per share because that cash has left the company. All right, that won't happen exactly in practice, but the price will generally go down. All right, so well, if I bought the stock right before this and then I sell it right after the dividend, right, what I have is a loss. Right, so I can deduct that loss. Right, and that's going to potentially, right, because I can deduct some net capital losses against my ordinary income. So I can get a deduction that's actually bigger than the income here if I'm only taxed on this at the preferential rate. Right, so because that would just be free money, that's why we have this rule. So you can't just come in and out really quickly. You have to hold it for a longer period of time, right, where you bear a lot more risk that the price will fluctuate. If that doesn't make sense to you, you can just remember what the rule is. If it's not a qualified dividend and it doesn't meet these, and it's going to be taxed at ordinary income rates. There's qualified and then there's overqualified. If we're talking about Chuck Norris, Maybe you saw in the news, Chuck Norris has been exposed to coronavirus COVID-19. The virus is now in quarantine for 14 days. Finally, some positive news out there. All right, so we learned in chapter 11 what is a capital asset. It's defined by what it's not, right? Usually, right, these are business types of things, right? So we know a lot of the assets used in a business held for more than a year are 1231. They have their own rules. Other business assets generate ordinary income. These are like business assets of creative, right? Artists, writers, composers, right? And so those are like business assets. And then there's this weird US government publication thing that doesn't hardly apply to anyone, right? But essentially these are going to be investments, things that you buy hoping that they'll pay you a regular return or that they'll go up in value, right? Investment assets, right? Or it could also include your personal use property. So the nice tax features of capital assets is that you don't have to pay tax on gains until you sell them, right? There's deferral, which is very valuable, right? Because of the realization requirement, there's no tax until there's a transaction and I actually realize the gain. I have to hold the asset for more than 1 year before I get the preferential rates, 0, 15, or 20%. If it's a year or less, then they're taxed as ordinary income at the ordinary rates. By default, we use first in, first out for stock, right? Which is going to give you the biggest gain usually, right? Because your older shares will probably have a lower basis. If you have sufficient records, you can use specific identification to try to lower your taxable gains. So the long-term capital gains rates are exactly the same as the qualified dividend rates. And you can, right, you're going to put ordinary income in first and see where you're at. 15% being the biggest bracket and the most common, but it could be 0 or 20. You can learn more about capital gains from this book by Chip Gaines. So we also learn now there's this other category. If I sold, for example, like real estate that's depreciated. Depreciation is going to lower my basis and make my gain bigger. That the part of the gain due to depreciation then, because it's real estate, it doesn't get recaptured like we would with personal property. So we call it unrecaptured 1250 gain. Right? We keep track of it because it can be taxed up to 25%, right? It's treated as a capital gain, but it gets a potentially higher tax rate. Going to be taxed at the ordinary rate if that's less than 25% for the taxpayer, but it can only go up to a max of 25%. So not as good as as regular long-term capital gains, but still you could potentially be taxed lower than other income. Another category of capital gains with its own rate is called collectibles. Also, there's this thing called qualified small business stock, right? There's a lot of different rules, but it's to encourage people to invest in small businesses. You can get a better rate on that as well. All right, so we're mainly going to talk about collectibles here. These are things that generally wealthier people might buy as an investment, like artwork, antiques, alcohol, like wines and things that appreciate over time, coins, stamps, precious metals like gold, silver. These are all taxed as collectibles. So they'll be taxed at your ordinary income rate if that's less than 28%, but the maximum you can pay on these is 28%. Right? The rationale for giving a preferential rate to encourage investment doesn't seem to apply to these things, right? We don't feel like we need to subsidize Greg Popovich's wine collection, but they still do get a rate that's better than ordinary rates for high income people. All right, if you've seen Antiques Roadshow, right? If somebody has one of those their item tends to be worth a lot, right? Now, you know, you could tell them that's probably going to be taxed up to 28%. So we know, right, if what we're going to do is we're going to take all of our capital gains and losses in a tax year, we're going to net them together. All right, so if I do that and I still end up with a net loss, up to 3,000 of that can be deducted against ordinary income, all right, which is a nice benefit. If my loss is bigger than 3,000, the rest will be carried forward indefinitely. FYI, corporations don't get to deduct any net capital loss. They can only use losses to offset capital gains. So here's a question. If a capital gain, right, is taxed, all right, so much better because I can defer it and then get a preferential rate, why would people still buy dividends, that maybe a stock that pays dividends every year and is taxed every year so you don't get deferral? Or especially, why would people buy a bond that pays interest that's taxed at ordinary rates every year? Well, as much as I hate to admit it, there are non-tax reasons to do things, right? And so, right, people buy some of these interest and dividend paying investments because they're viewed as less risky, right? You get the money now, and right, some of them are very highly rated, stable companies, right? So there's the risk aspect, there's a diversification aspect, and then there is a tax reason as well, in that there's a lot of entities out there that are tax exempt, right? Like a nonprofit. A more accurate term for nonprofit is tax exempt, right? So they don't care because they won't pay income tax anyway. All right, so we're going to stop there, and then we'll do a separate video just to digest the netting process and do examples of that.